All right, so now we are starting the next topic, which is corporate governance. And in this session, we are going to have the introduction of the corporate governance, and then in the next video, we'll be doing this thing in detail. The first thing you have to understand is actually the exam focus. How this area is tested in the exam. So there are two main types, or you can say three. The first is the objective test questions. You may have some MCQs from this area. The second is the knowledge based. That means a straightforward question. For example, they ask you regarding the nomination committee, they ask you regarding the remuneration committee, they ask you regarding something regarding the NEDs, etc. And the third and the main question is the case study, which have been tested many times. And when it comes, it asks you to identify and explain the corporate governance deficiencies. The corporate governance deficiencies, there will be a case study given to you, and the examiner asks you to identify the corporate governance deficiencies. Like, say, for example, according to the corporate governance, the chairman and CEO should be a separate person. A single person should not serve as a CEO and the chairman. By law, it can be, but by corporate governance, it should not be. So if there is a single person who is the CEO as well as the chairman, then there is a lack of accountability and lack of transparency. And a single person is having too much power that he can be biased, and obviously there may be a significant agency problem. This is the identification and explanation. Now, identify and explain the corporate governance deficiencies and provide recommendation. Now, the recommendation is, for example, a single person is serving as the CEO and the chairman. He should step down from the one role and another chairman should be appointed, for example. Or, for example, according to the corporate governance, at least half of the board, excluding the chairman, should be consisted of independent non-executive directors. For example, if there are seven, take out the chairman. So three should be EDs and three should be NADs. So if in the exam it is written that there are 2 NADs and 8 EDs, so that means there is no balance in the board, and an unbalanced board may not be competent enough, efficient enough for the company, and there is a lack of accountability, lack of monitoring, lack of strategic ideas. So the recommendation is that the board should hire some more NEDs. So there will be a question given to you, and it came many times. Identify and explain the corporate governance deficiencies and provide recommendations. The knowledge base, you have the straightforward stuff, which I'll be telling you which to learn by heart. And the objective test question, obviously, this is going to be, this is going to be the conceptual thing. If you know the topic, you will be easily, solving the objective test questions. So this was the first thing, that is the exam focus. Now the definition. Is corporate governance is a system through or by which companies are directed and controlled. Now, in order to understand the corporate governance, you have to go in the background. Now, the background of the corporate governance is the same like agency theory. So there were a number of corporate scandals, and some of the major scandals which you may have heard already is, for example, Enron and South Seas, and for example Lehman Brothers, .com, Bearing Bank, etc. So these are the world-renowned scandals which led to the need of the corporate governance. Now, after these scandals, there was a significant need of having some rules or principles which governs the companies and should be applied either as a law or best practice. Now, after these corporate scandals, there was a need that there should be some rules or the principles which should be applied on the companies, and either it should be applied as a law or it should be a best practice. Now, this gives rise to a concept of the rule-based corporate governance and the principle-based corporate governance. Rule-based approach is a law and failure to comply results in fines and penalties and sometimes revocation of the licenses, the company license, and such as US Sarbanes-Oxley Act. The US Sarbanes-Oxley Act in short, it is known as the SOX, is an example of rule-based approach. It came in 2002. So it is a law for the companies, and the companies are bound to follow that. Whatever the provisions are there, whatever the clauses and sections are there, the companies are bound to follow. For example, there is a section over there which is known as that the board and the management should prepare internal control effectiveness report, and the auditor should give an attestation report on that. Similarly, there is a section in that, for example, if the directors have taken the bonus based on the profits and later it proved that the profits were manipulated by for taking the bonuses, so they have to return the extra bonus which they have got. So sections like this, law, it's a law. gives protection to the whistleblowers, etc. So principle-based approach is not the law, but it's the best practice. Principle-based approach is not a law, but it's the best practice. And this means comply or explain. Like for example, the corporate governance says that the CEO and the chairman should be two separate persons. So either you have to comply with it, that you have the separate persons for these two designations, or you have to explain. Like for example, around in 2005, if I'm not wrong, in 2005, the Marks and Spencer was having a single person was serving on the chairman and as a chairman and the CEO. So they explained it in their corporate governance report that why there is a need of that. So best practice, either you have to comply with it or you have to explain it, such as UK Code of Corporate Governance. So the corporate governance is the system by which companies are directed and controlled. It provides the best practices and rules or the guidelines to the company that they should follow this. Now, what are the benefits? What are the benefits of following those provisions which are mentioned either in the rules or in the best practices? What are the benefits to the company of following the corporate governance? It reduces the risk of fraud, as the major issue in the past was the corporate scandals such as Enron, South Seas Bubble, and Lehman Brothers.com, Bearing Bank, etc. So it ensures effective internal control system and prudent risk management. Now, in the past, there were some corporate failures due to the weak internal controls, that there were the loopholes in the internal control system which the directors were exploiting. And similarly, they were taking excessive risks against the approach of the shareholders. So no one was challenging their risk policy. Now, after the corporate governance, there are special provisions regarding the internal control system and risk management so that the risk taken by the company is actually uh, is actually linked with the shareholder approach. Like if they want excessive risk, the company is taking that. If they're moderate, so moderate risks are taken. So the corporate governance have now the risk committee, which ensure that the risks are responsible decisions. Similarly, it protects the shareholders' investment. Now, in the past, when there were corporate scandals, a lot of people lost their money in the stock market, and as a result, there was a huge drop in the companies as well as the stock market. So the investors were not protected. They were investing and they were losing their money. So after the corporate governance, the stock market has now a reputation, and even the general people can invest quite, fluently and quite inhesitantly in the stock market because the corporate governance gives the protection to the shareholders. It safeguards the assets of the company. Now, previously, those directors who did the fraud, they were actually keeping the company's assets as a collateral and were taking excessive loans for their personal use and for personal benefits. And when they were unable to pay those loans, the company used to get liquidated. So the corporate governance protects the assets of, safeguards the assets of the company. So these are the benefits. Now, hopefully you have understood that corporate governance is a system through which or by which companies are directed and controlled, and the background is the number of corporate scandals where the common things were too much power in a single hand. There was only the CEO and he was not challenged by anyone. Just nowadays we have the chairman who can keep a check on the CEO's decision, and weak internal controls, no risk policy. So that is why there were a number of frauds, and after these scandals, the government came into action. There was a discussion in the parliaments, a lot of bills were passed, a lot of work was done, and as a result, there were two types of approaches introduced in different jurisdictions: rule-based approach in US and the principle-based approach in UK. Although it started in 1992 when there was a Cadbury report, which was the first report on the corporate governance, and then it has some benefits. So this is the introduction of the corporate governance, and in the next video we'll be doing this in quite detail. All right, dear students, in the last lecture we discussed the introduction to the corporate governance, and let's revise this thing quickly. I told you first of all the exam focus points. Now the exam focus points were that in the exam from the corporate governance you may have the objective test question, that means the MCQs or match the following things, etc., and the knowledge base, which requires you to write a straightforward thing, and the case study, which requires you to identify and explain the deficiencies, the corporate governance deficiencies, and provide the recommendation. Then we discuss, sorry, the definition of the corporate governance, that it is a system through which companies are directed and controlled. Now, in the past, we were having the corporate scandals. That was the reason to bring the corporate governance. The corporate scandals uh, were actually destroyed the companies as well as the investors, and a lot of general public and a lot of investors lost their money. So there was too much pressure on the government to bring something either in the form of the principle or in the form of the rules, so that companies are obliged to follow those principles as well as rules, so that there are very less chances of the companies getting failed. So the objective of the corporate governance was to bring the transparency, accountability, to make sure the investment of the shareholders is protected, it safeguards the assets of the company, it ensures the effective internal controls, and prudent risk management reduces the chances of the frauds. And there are two types of the corporate governance, two approaches: the rule-based approach, which is the law, such as Sarbanes-Oxley, and the principle-based approach, which is the best practice and in which you have to comply or explain. This is what we did in the last lecture. Now today we are stepping ahead and we'll be discussing further topics. And the first thing is the structure of the board. Now in the companies, we have two types of directors: executive directors and non-executive directors. So EDs in short, and NEDs. So EDs leads the day-to-day functions or operations, whatever you call it. Day-to-day functions. For example, finance function, so finance director. HR function, so HR director. Sales function, sales director. marketing function, marketing director, etc. On the other hand, NEDs, they have 4 roles in the companies. Number 1, strategy role. Number 2, performance role. Number 3, people role. And number 4, risk role. EDs are permanent employees of the company. NEDs are not the employees. Instead, they serve part-time. EDs get remuneration, which is mainly performance related. NEDs get fixed remuneration and should not be performance related. The remuneration components of the EDs include salary, bonus, benefits, pension, share options, etc. And the major component of their remuneration is performance related. Now, performance related means mainly the bonuses, the share options, performance related elements. That their major remuneration is performance related so that they work hard for the company. NEDs, on the other hand, they should not be given performance related because otherwise should not be given performance related, otherwise they will become the right hand of the executives. So non-executive directors, serve part-time, and they have 4 roles in the companies. Strategy role, that means contribute. They contribute in the strategy. That means they give their contribution when the strategy is formulated. Performance role means they monitor the performance of EDs. They monitor the EDs. So they are a check on the EDs because EDs are running the day-to-day functions. They are leading the day-to-day functions. So it's a check placed by the shareholders internally on the EDs. NEDs keeps checks on the EDs so that the decisions EDs are taking are in the best interest of the company and the shareholder. People role means remuneration of EDs the NEDs decides the remuneration of the executive directors. Sorry for my cough. Okay, sorry in advance. I cannot do anything regarding this. Okay, remuneration of EDs, and the second thing is nomination. Nomination. Now, nomination means they when a new director is required on the board, so they shortlist those directors and they nominate to the board for the final selection. That is the people role. And then you have the risk role. That means responsibilities related to risk management. So NEDs, they serve part-time. They have 4 roles. Strategy role, that means contributions in the strategy of the company. Performance role, that means they monitor the EDs. People role decides the remuneration of EDs. Nomination of EDs. And risk role, which means responsibilities related to risk management. Executive director, on the other hand, are the permanent employees of the company. They lead day-to-day functions such as finance director, HR director, and they're mainly the remuneration is performance related, and otherwise they get a balanced remuneration. A balanced remuneration. This is the balanced remuneration. They get the salary, which is the minimum guaranteed portion. Bonuses are performance related so that they are being motivated. Benefits are according to the designation and the scale. Pension is to give them the flavor that they retain in the company for a longer run. They serve the company for a longer run, and they obviously they have the security that when they retire from the company they will be having enough money to deal with the rest of the life. And share options are just to give them a flavor that they are a shareholder as well, so they will then take care of the share price. So this is the balanced remuneration. Now, chief executive officer, CEO, is the head of the EDs, and chairman is the head of NEDs as well as the board. So chairman is the head of the NEDs as well as the board. So important thing, according to the code of corporate governance, CEO and the chairman should be two separate person. That means that is a single person should not have both designations to ensure accountability. Because if the CEO and the chairman is separate, then the chairman along with other NEDs will be able to keep the check on the CEO and other EDs. So according to the code of corporate governance, but according to the company law, a single person can be the chairman and the CEO, but we are talking about the code of the corporate governance because we are reading and studying the corporate governance. So now we have the roles of the chairman. What are the roles of the chairman? So chairman Chairman is the public face of the company. Like whenever you see someone is addressing on the press or the media, it is usually the chairman who is coming on the press and the media and saying something about the company. Public face of the company. Key contact to the shareholders. So who is actually reporting regarding everything to the shareholders? It is usually the chairman. Although chief executive has the direct contact with the shareholders as well, but regarding the monitoring and supervising, it is the chairman. Responsible for conducting AGM. It is the responsibility of the chairman to ensure there is a proper AGM, the shareholders are being communicated and motivated to attend the AGM. Similarly, responsible for conducting AGMs and responsible for building an effective relationship between EDs and NEDs. All right, so etc. Also responsible for induction training of newly appointed directors. If someone is new to the company, the chairman should give them the induction training. That means, like telling them regarding the company's culture, company's values, ethics, norms, policies, regarding the major customers, major suppliers, major contracts, mission, visions, etc. Now, again, one more thing which is very important. According to the Code of Corporate Governance, at least half of the board excluding the chairman should be consisted of independent non-executive directors. According to the Code of the Corporate Governance, at least half of the board, excluding the chairman, should be consisted of independent non-executive directors. For example, if there are 7 directors in the board, including chairman, so 3 should be EDs and 3 should be NEDs. Because if there are less NEDs, then there will be less supervision, less accountability, less contribution in the strategy. So there should be a balance of EDs and NEDs. Now, the next topic is responsibilities of the board. The board leads the company, provides direction, provides the direction and responsible for the success of the company. Now, board retains some responsibilities. Some responsibilities are retained by board. Some responsibilities are delegated. Now, the responsibilities which are retained by the board, that means the activities they are, the decision they are doing themselves are strategic decisions. The long-term and significant decisions, such as financing decisions, such as restructuring decision, such as dividends decisions. And then they delegate some responsibilities. For example, to individual directors and to the board committees. Delegates responsibilities, for example, to individual directors, like who deals with the finance function, finance decisions, not financing decisions, finance decisions, finance director. Similarly, HR directors do the basic hiring and firing. And then responsibilities are delegated to the board committees. Now, why are the responsibilities are delegated to board committees? Because everything cannot be done by the board itself. And secondly, the board is responsible for the tasks they have been given. Board committees. Now, there are 4 types. 3 are the major, and the other one is the 4th. So, audit committee, remuneration committee, nomination committee, and risk committee. Audit committee, remuneration committee, nomination committee, and risk committee. So now we'll be discussing the committees, board committees. Now I'll be discussing the board committees. So first of all, the audit committee. Now in the composition, there are entire independent non-executive directors and at least one director with financial qualification, or you can say with relevant financial qualification, accountancy qualification. Financial qualification and experience. So this is the composition. Now the objective and roles. So the objectives are to ensure integrity of financial reporting and to ensure integrity of auditing. Now the audit committee within the organizations ensures that the financial information produced by the company or the system has the integrity and is effective. Reliable information is produced by the system. That is why audit committee ensures that the internal control system of the organization is effective. When the control will be effective, the information produced by the system will have the integrity. And then there is integrity of auditing, both the internal and external. That is why in the organization, internal auditor reports to the audit committee. Internal auditor works under the audit committee. The scope of the internal audit function is decided by the audit committee. The chief internal auditor, which is the senior most position of the internal audit, discusses all the matters with the audit committee. Internal control system evaluation is done under the audit committee. And similarly, when it comes to external auditor, so shortlisting the firm, the tendering process, dealing with the audit fee and the audit issues, all is done by the audit committee. So in the integrity of the auditing, it deals with both the internal audit as well as external audit. And I've explained the roles as well. So then you have the remuneration committee. Again, first of all, there is the composition. Entire non-executive directors. So even in the audit committee, entire non-executive directors, remuneration committee, non-executive directors. Because in the audit committee, you are keeping the check of the ED. So if there are EDs involved in the audit committee, they will be self-review thread. They will be reviewing their own work. In the remuneration committee, if there are EDs, they will be deciding their own salary. So there will be self-interest. In the large company, there should be 3 NEDs in the audit committee and the remuneration committee. In the small and medium, there should be 2. So composition, entire NEDs. And then objective and roles. So objective is deciding the remuneration of the EDs. And then some other roles such as setting performance targets. Like I told you that the main remuneration of the ED is performance related. So setting performance targets, evaluation against targets, balanced remuneration, offering balanced remuneration. Balance means that the ED should not be offered such a remuneration that they get demotivated. Even they should not be offered such remuneration which is exploited by them. So balanced remuneration, that means keeps them motivated as well as they are acting in the best interest of the company. They're not getting for the work they have not done. So they should not be paid for the failures. They should only be paid for the what the success they have brought to the company. Balanced remuneration according to board's policy. Then you have nomination committee. First of all, the composition. Now, mainly NEDs, mainly NEDs, but EDs as well for technical and professional support. So what are the objective and roles? So objectives is nomination of directors to the board for final selection. Succession planning. Succession planning is preparing the replacement in advance. If someone is leaving, so they should prepare the replacement in advance. Ensuring a balanced board, that in terms of quantity, first of all, the half of the board excluding the chairman should be consisted of independent non-executive directors. Then ensuring quality, that means ensuring that the board has the blend of skills, knowledge, and expertise. And then the risk committee, which mainly consists of NEDs and some EDs as well for again technical support. It deals with the risk management, so there is no need to write that. Okay, then few more things such as AGM. Now AGM is the annual general meeting. So it is the responsibility of the chairman to ensure that they are conducting an AGM and they are motivating the shareholders to attend that. Performance appraisals. Again, it is the responsibility of the chairman to conduct annual performance appraisals of the board, individual directors, as well as the committees. So AGMs, performance appraisals, induction trainings, we already discussed that, and etc. That's it. So these are the things now we have discussed in detail. So structure of the board, and yeah, no, there's one more thing. Yeah, independence of NEDs. Independence of NEDs. Okay, now independence of NEDs, there are a few points. First of all, an ED cannot become NED immediately after retirement. NED cannot become NED immediately after retirement, so there should be a gap of 2 years, otherwise it is not going to be considered independent. NED should not serve on the board for more than 9 years, otherwise they are not going to be considered independent. No relationship such as family, business, personal relationship with EDs and the company, otherwise they will not be considered sorry, independent. Similarly, no cross directorship. No cross directorship. That means, like for example, there is a company A and there's a company B. The ED of company A is the NED of the company B, and the ED of the company B is the NED of company A. Okay, so I'll scratch your back and you'll scratch mine. So obviously, like if you are AD here and NED over there, so I'll scratch your back and you will scratch mine. So no cross directorship. And retirement by rotation. Retirement by rotation means that directors are elected for 3 years, and after that they present themselves for re-election. So this is the complete corporate governance. This is the complete corporate governance. In the last lecture, we did the introduction, and now this is the full corporate governance, each and every point that you should know if you want to attempt the paper. And in the paper, you have objective test questions, you have the knowledge-based area, and you have the case study. We'll be doing questions as well.